Welcome back, everybody. Today, I'm going to break down the topic of tax fraud. I'll tell you everything that you need to know about what it is, how it works, so you can avoid getting into legal trouble when it comes to your taxes, and you definitely want to stay out of prison. Without further ado, let's dive in. All right, guys, first things first is, what is tax fraud? Tax fraud is the illegal act of intentionally falsifying information on a tax return or evading taxes owed to a government. It involves deliberate deception to avoid paying the correct amount of taxes. And with tax fraud, there is a willful misconduct, like lying on your tax returns or keeping two sets of books for your business. The penalties for tax fraud are pretty severe, including fines of up to hundreds of thousands of dollars and imprisonment of up to 5 to 10 years, depending on the crime and the restitution. Now, in order to be found guilty of tax fraud, the IRS must prove intent to falsify information, often through patterns of deceit. Now, we'll talk about the differences between tax fraud and tax negligence. Tax fraud is different from tax negligence. Tax negligence is the act of making unintentional errors or being careless in tax reporting, such as miscalculating deductions or overlooking income or just failing to keep accurate records without intent to deceive the IRS. Penalties are a lot lighter, and typically they average at around 20% for accuracy-related penalties on the underpaid tax, with no criminal charges unless the negligence is extreme or habitual. Now, corrections are often handled through what's called amended returns, where you refile your tax return, or audits. The tax code is extremely complex, so the IRS actually expects to see minor errors on a large percentage of returns. After all, most people don't have the time, the energy, or the will to study the 6,000 plus page tax code to fully understand every single rule and regulation. But of course, this is why many people hire tax professionals to help them file their taxes, and doing so can be highly beneficial. But what are the most common types of tax fraud? When it comes to tax fraud, some types of tax fraud are far more common than others. Here are 5 of the most common types of tax fraud. The IRS focuses heavily on these areas. Number 1, underreporting income. This means deliberately omitting or understating income to reduce your taxable income. This type of tax fraud is extremely common for cash-based business owners, such as tips and freelance workers. However, this could change now that people who earned tip income are able to receive a deduction of up to $25,000 after the big beautiful bill was passed on July 4th, 2025. Next, number 2 is falsely claiming or exaggerating tax credits or deductions. Some people try to claim tax credits or deductions that they're not actually eligible for, or they dramatically exaggerate details related to credits or deductions. For example, if they're trying to write off a business vehicle, they may say that they use the vehicle 100% of the time for business, even though they really only used it for 50% for business. In this way, they might try to write off the full cost of the car using bonus depreciation, even though they may only be eligible to write off 50% of the cost of the car. Or a person may try to write off a personal or a family vacation in which they did not conduct any business activity. If you're a business owner, then yes, you can write off a wide variety of expenses related to business travel, but there has to be an actual business purpose that justifies the business travel, such as meeting with suppliers, scouting business locations, attending a trade show, and much more. Also, make sure you keep accurate logs of all of your business travel and all of your business activity, because you're going to need this in the event you're audited by the IRS. If you want to write off your business travel expenses correctly, you have to document your travel expenses. Now, I did a whole video on this topic, so I'm not going to spend more time talking about it, but if you would love to learn more, check out this video right here. All right, now moving on to number 3, hiding assets offshore. This is the process of concealing income or assets in offshore accounts or trusts to avoid taxation. This often involves complex schemes to obscure ownership or income sources. If you're an American citizen, you're allowed to have offshore bank accounts, but there are strict rules for this. For example, you have to file what's called FinCEN Form 114. It's an FBAR form with the Treasury Department, and this will aggregate the value of your foreign financial accounts that exceed $10,000 at any time during the year. You have to document this. This includes bank accounts, brokerage accounts, and certain foreign pensions that you're receiving. You also must declare all income earned from offshore accounts, such as interest income, dividends, capital gains, etc., on your U.S. tax return, even if it's taxed abroad. The United States taxes foreign income and taxes on your foreign earned income. So keep this in mind. There is an exclusion amount. However, you have to earn over a certain amount for your foreign income to be taxed. For 2025, that amount is $130,000. Now, number 4 is filing false returns. A false return is a tax return that has fake information, such as fake W-2s, inflated losses, fictitious businesses, and much more. This is all in the attempt to reduce taxes owed or inflate refunds. Some people simply add a bunch of fake information to their tax returns to try to trick the IRS into thinking that they either did not make as much money as they actually did or that they owe less than what they really do. The IRS has a system in place that looks for this type of tax fraud. They are very smart. The system detects specific anomalies, then your tax return can be flagged to be reviewed by an actual human. That is the point where the IRS can decide to audit you if they want to. If the IRS suspects that there is a criminal activity, it just may pursue a criminal investigation right out the gate. Some people think that being investigated by the IRS isn't that big of a deal, and it's not an agency like the FBI or the Department of Justice. But let me remind you, the IRS has brought down Al Capone, okay? Arguably the most notorious gangster in American history, in case you didn't know. It was through fraud. He had fraudulent tax returns. The IRS got him, not the FBI, the IRS. And this leads me to number 5, employment tax fraud. This form of tax fraud involves employers deliberately violating tax laws by failing to withhold, report, or pay payroll taxes, such as federal income tax, Social Security tax, Medicare tax, and sometimes even state or local taxes that are owed to the IRS or other state authorities on behalf of your employees. You see, employers are required to withhold these taxes from employees' wages and contribute their own share, such as matching the Social Security, matching the Medicare, and remit the funds to the IRS on a regular schedule, which is typically monthly or quarterly, depending on when their employees are getting paid. Employment fraud occurs when employers do things like underreport wages by paying employees under the table in cash or not withholding required taxes. Other common employment fraud schemes include misclassifying employees as independent contractors to avoid payroll taxes, filing false Form 941 with inaccurate wage and tax data, which is your payroll form, and collecting taxes but repeatedly failing to pay them. All of this can be avoided. Only a very small number of people are convicted of tax fraud every year. And in fact, the IRS only opens a few thousand tax fraud cases per year. This is because most people at least attempt to file their taxes correctly, but it's still absolutely critical to try to make your tax returns as perfect as possible to make sure that the IRS doesn't accidentally think that you are trying to commit tax fraud. Here are some tips to do this. Work with a tax professional to prepare your taxes. If you're a mid to high earner, there's really no need to prepare your taxes yourself. You can work with a professional tax preparer to do your taxes. There becomes a point in time where you're like, dude, I'm not going underneath my car to change the oil anymore. I'm gonna go to Jiffy Lube. I'm gonna go to somebody else to change the tire. You need to figure out when that moment is for you that you're gonna go to somebody else to file your tax returns. If you're making a few six figures, yes, it's at the point where you need to do that. These people specialize in tax preparation and they do it every single day. So why not work with them to reduce the chances of you making mistakes? If you don't want to do that, at least work with a tax preparation software such as TurboTax. I hate to say it, but yes, TurboTax can help you do your taxes. Work with a tax strategy firm to implement advanced tax strategies as well. There's nothing wrong with trying to save a substantial money on your taxes, but if you're going to do this, you should work with a high quality tax strategy firm such as my company, Tax Alchemy. We will help you to get this done before the end of the year. We specialize in implementing sophisticated tax strategies that substantially reduce tax. We only use strategies firmly rooted in US tax law that are fully compliant with IRS guidelines. We don't play games. We also offer tax prep for certain clients. If you want to learn more about this, click on the link in the description, book a call with my team. We'd be more than happy to help you. Now, please be extremely careful with any offshore bank accounts. This is one of those areas of the tax code where the government has the strictest punishments. Willful failure to file a report of foreign banks or foreign accounts or FBAR while violating another US law or as a part of a pattern of illegal activity exceeding $100,000 in a 12-month period can result in penalties of up to $500,000 and imprisonment of up to 10 years. So this is not something you want to play around with. If you have foreign banks or financial accounts, you need to take great care to report them accurately and in full compliance with the law. This is one of the areas of tax compliance that you really don't want to mess around with. My name is Karlton Dennis. If you like this video, you know what to do. Like, comment, subscribe, and share this video with one person that's willing to learn and build wealth by following the right information. Look forward to seeing you on the next video. Cheers.